Hello friends, today we are going to discuss a very important topic of valuation. In fact, this is the topic which determines the amount of tax which has to be paid by a supplier to the government. Friends, this issue of valuation has always been a subject matter of litigation because supplier would like to reduce the value on which is liable to pay the tax, and department will always suspect the value which is being declared by the supplier. By undervaluing the valuation, not only I am evading this GST, which of course is a combined rate of tax presently, and of course a great incentive to evade the tax, I also save income tax, which is much more than the liability of GST in most of the cases. To give an example, if I reduce my value 100 rupees, of course I'll book all my expenditure, I'll claim all the credit. I will not only save, let us say 18% GST, I will also save 30 plus cess, whatever is the rate applicable to me from income tax also. So this matter has always been litigated between the department and the revenue. When it comes to GST, I would like to deal with a couple of important issues which differentiate the valuation under GST vis-a-vis the earlier taxation laws. First of all, in excise, we used to have a concept of MRP valuation, which is certainly not there now. It is only the transactional value which is liable to be taxed. This valuation section, that is section 15, and 9 rules starting from 27 to 35 are applicable to all GST acts, CGST, SGST, UTGST or IGST. Moreover, it is also important to understand that these valuation principles are same so far as goods and services both are concerned. With this introduction, we'll move to the section first, and the section is section 15. If you look at the charging section, which is always the most important section in any fiscal law, it clearly talks about that the tax shall be levied on the value determined under section 15. So the mention of section 15 in the charging section itself underlines the importance of this section. The value is to be determined in terms of section 15, and wherever it cannot be determined by virtue of subsection of section 15, then we have to refer to the rules. We will discuss all the subclauses of the section 15 and also each rule relating to the valuation. First of all, as I told you, the tax is to be paid on the transactional value subject to two conditions, that the supplier and recipient both are not related to each other and price is the sole consideration. I would like to move one step ahead. I say even if supplier and recipients are related and that relationship has not influenced the price which is being paid or payable. Kindly understand, paid or payable means if I am getting something in advance or at the time of the transaction and some amount is payable after 3 months, so it is the gross amount which is payable against that supply is subject to tax. So I was coming to the issue that even if supplier and recipient both are related and that relationship has not affected the price, it is the transactional value which is subject to tax. According to my understanding, this is the most fair language used by the department, and if both department as well as the assessee both act and follow this principle in letter and spirit, there cannot be any dispute on the valuation. But as I told you, there is a great incentive to undervalue the supplies. As I have already stated, I will once again repeat for the sake of repetition, it will not only result in the saving of GST but also in income tax. So that is the temptation, and these provisions are not being implemented religiously. Now coming to the issue that in most of the situation you will find that these supplies are mainly in cash. There are very few transactions where the consideration comes in cash as well as in kind. So what I am saying, it is actual price paid or payable if the valuation, if the whole consideration is in cash, then certainly as per section 15.1 it is the transactional value. And if we go to the 15.2 section, it talk about certain components which are to be included in the value of supply. And one of such component is that where supplier and recipient are not related in price, the sole consideration, there is no one non-monetary consideration, then transactional value already stated. What are to be included is being provided in section 15.2. And what is specifically being included is any taxes, duties, cess, fees, and charges levied under any statute other than GST law. Examples may be entertainment tax or municipal tax levied by the local authorities, or for that matter, even custom duty. Once I am importing the goods, I am liable to pay custom duty as well as IGST. So the custom duty shall form part of the price on which IGST is to be calculated. For example, I am importing certain goods, 100 rupees the value, 15 rupees is the custom duty, 115. So I am liable to pay tax on 115 rupees. To that extent, it is cascading. Not only that, another important thing which need to be remembered here is that once it comes to the import of goods, then this section 15 and the relevant rules 27 to 35 shall not be applicable, because in the case of import, the valuation has to be done in terms of the custom law, and that proposition is not being dealt in these slides, and I am not discussing with that. Looking to the fact, very few professionals will be interested in that. Then comes the second inclusion, which is really very important: payment made by recipient on behalf of supplier in relation to sub-supply. I think this we need to understand because it has got a very wide ramification. Let us say I am buying a sofa set from a person, and that sofa set is to be delivered at my sister's place, and the consideration being settled is 10,000 rupees plus 1,500 as freight, 11,500. Obviously, once the delivery is to be given to my sister place, and that is the time when the transaction will be completed and the whole expenditure including transportation is to be borne by the supplier, then logically and legally I am supposed to pay tax on 11,500 rupees. But if I say I am a smart guy, I raise an invoice of 10,000 rupees, issued a GR with to pay, and ask me whether your sister can pay this freight on my behalf. So I give him 10,000 rupees, I issued an invoice of 10,000, 1,500 is being paid by my sister to the transporter. How the department will come to know that this 1,500 is also subject to GST? I do agree, if this transaction is between one registered person to another registered person, that means it is a B2B transaction, it may not have much effect. Because in any case, if I will charge tax on 1,500 rupees also, you will get the full credit thereof. It is not going to make any difference. But in case it is a B2C supply, like in this case, so it is going to be affected. So in this case, when you need to be very, very careful and look at the terms of the supply, and then look at it who has paid the consideration which was liable to be paid by the supplier. Similarly, now I am dealing with my professional brothers. Let us say in the case of a chartered accountant also, if my fees is 10,000 rupees and I ask my client, you have to book my ticket in addition to my professional fees, then on which value the GST is leviable, and if I include the freight charges into my invoice, which is another term of arrangement wherein I can quote, I will charge you 110 rupees, assuming 10 rupees the ticket charge. Will it make any difference? Yes, if you look at apparent calculation, it appears that I am saving some tax, but it is not so. I'll explain it in detail. Let us say 100 rupees is the amount of my fees. I will charge 18 rupees as GST. 10 rupees is the freight charges, my transport, my ticket from one place to another, and assuming 1 rupee for the sake of simplicity of calculation is the GST. Now, if that 11 rupees has been incurred by the client, 1 rupee is entitled to claim the credit. It is costing him 10 rupees, and I will charge 100 plus 18. He will pay me 118, claim the credit of rupees 18, and the government will get 18 rupees through me and 1 rupee through my client, and 19 rupees will go to the government. Now assume I change the terms of the contract and I say that this freight will be borne by me and I will charge you 110 rupees. So once I will charge you 110 rupees, 18% is the value. So the GST amount will be 19 rupees 80 paisa. So obviously I will book my ticket, I will claim the credit of 1 rupee and pay to the government 18 rupees 80 paisa. So that means the government has received an amount of 19 rupees 80 paisa. Is it a planning which can be done under valuation? Or it is only a mirage, only a myth? There is nothing which is going to be saved. I'll say it is only a myth. Even if I charge 19 rupees 80 paisa, whereas in the earlier proposition the amount paid was 19 rupees, it is not going to make any difference because my client who has collected, let us say 5,000 rupees from his customer, he will claim the credit of 19 rupees 80 paisa and pay rest to the government. So even by splitting up the transaction, apparently it appears that I am saving the tax, that the government is getting less tax, but there is no less revenue earned by the government also, because whatever amount government has collected, the same amount they are paying as a credit. So government when getting 1980, the credit is also being issued for 1980. The government when getting 18 rupees is also getting the 18 rupees. Similar is the case in the case of trading also. For example, I am selling a goods which is liable to be taxed at 100 rupees and the rate of GST is 18%. Let us say 10,000 is the price of that material. Now 1800 is the value of GST. Now let us assume there is a 2000 transportation cost. Assuming that 2000 transaction cost is being paid by the supplier, then the amount shall be paid at the rate of 12% under forward charge also. So in any case, if I add 12,000 rupees and charge 18% on that, which works out to be 2,180 rupees, 160 rupees out from the client. And in the earlier situation, I will pay 18% on 10,000, 1,800 plus 12% on 2,000, 240 as transportation charges. Again, the same principle will apply. By splitting of this transaction, I am not saving any tax so long as it is a B2B transaction. Because once the government will get less tax, the same amount will be claimed by the recipient as a credit, that same credit will be received by him. But yes, if it is a B2C transaction, this principle need to be looked into, and in case I am into B2C transaction, then obviously the element of freight packing which will attract tax at lower rate has to be segregated and it should not be borne by the supplier. Rather, in terms of the agreement, let that freight be borne by the recipient. If it is to be borne by the recipient, certainly it will not be added. Here, what is to be added is the amount which supplier was liable to pay, but it has been paid by the recipient and the amount has not been charged in the invoice. If it is being charged in the invoice, even then there will be no issue. Now, coming to another issue, incidental expenses like commission and packing charge by the supplier. So all these expenses which are being incurred at the time or before the delivery has to be included into the sale price. In fact, this is a concept which is being borrowed from the VAT law, where the sale price was anything being charged before or at the time of delivery of goods. And I think it's a settled proposition of law and need not require any further discussion. Now, what is to be excluded? It is again a very, very important issue. Discount is to be excluded from the value of supply. What kind of discount? One discount which I am showing on the invoice itself. There cannot be any doubts about that, and there is already a settled proposition of law in the VAT also. if I am charging someone 100 rupees and then he has negotiated the price for 80, 20 rupees the discount shown in the invoice, either it's a trade discount, cash discount or whatever you may call it, then on rest of the 80 rupees, GST is leviable. So of course there cannot be any dispute with regard to that. Even Supreme Court in the case of Maya traders has already said even post-supply discounts cannot be subject to VAT because they are very normal to be given in the trade and it's a very common practice. But in GST law, they have created a specific provision. They say if the discount is after supply, then it shall be reduced from the value of supply only when these two conditions are being satisfied. Condition number one, that discount must have been agreed before the date of supply. And number two, that discount is linked with each invoice and later on the credit note is being issued. And if the supplier wants to reduce the tax liability, that can be reduced only when the ITC claimed by the recipient is also being reversed. Here, two things are really important to understand with regard to post-supply discount. Can I enter into an arrangement, let us say from 1st April, and I say, in case you will sell 100 products within the first 6 months of this financial year, April to September, then you will be entitled to discount as mutually agreed between supplier and the recipient. In such situation, there is already authority of advance holding. We'll come to that. I'll discuss with that part. In such situation, discount shall not be reduced from the value of supply. But yes, if I say you will get an additional discount of 2% on the invoices issued between April to September, and I issue a credit note with reference to each invoice as of now, as the law stands today, then this shall not form part of the value of supply. Now, once the supplier and recipient are not related, then transactional value if the consideration is wholly in money. We will come to the rules now in case these provisions are not applicable. But before I do that, I'll come to subsection 5 of section 15, which gives a power to the government, wherein the government can notify this nature of supply for which the valuation will be done in the predetermined manner. So that means a deeming fiction is being created, wherein the government can lay down the procedure to be followed for the purpose of valuation, irrespective of what is the transactional value. Then friends, now we can move to another clause, that is 15.4, which says if supplier and recipients are related, a price is not the sole consideration, then that means if the value cannot be determined in terms of subsection 1 of section 15, then we have to move to the rules. Now, this is the table which is being given here. So, this 27 to 35 rules are the relevant rules which we will be discussing. But before we discuss these rules, I think it is very important to understand certain terms which have been used in these rules very frequently. One of such terms is open market value. Open market value has been defined in explanation to Rule 31. What is the open market value? Value of consideration. I'm sorry because these slides have been somewhere. Sorry, I'll go through my own slide because these slides are not mentioned in the similar manner the way I want to speak. But anyway, I'm having my own slides, so I'm discussing the term open market value, which has been explained in explanation A to Rule 35 of CGST rules. Open market value of a supply of goods or services or both means the full value in money, excluding central, state, union territory and integrated tax, where the supplier and the recipient of the supply is not related and the price is the sole consideration to obtain such supply at the same time. That is, the timing of the supply is important. So in fact, it also talks about a fair price which is normally payable between the supplier and the recipient, if it is being sold to somebody else who are not related, then like, kind and quantity. This is the term which has been used in number of rules, and it is further defined in Rule 35, explanation B. It means any other supply of goods or services or both made under similar circumstances, that is in respect of characteristics of that supply, quality, quantity, functional component, the kind of functions it can perform, materials, brand name, reputation of the goods or service, and it substantially resembles that supply. So that means if open market value is not available and that supply of like, kind and quantity, what kind of price it can fetch if it is between two unrelated persons, and price is the sole consideration. That is the value of this like, kind, quantity. Then the definition of related person, it is already given there and it has to be read very carefully, because in the case of related person, certainly this 15.1 is not applicable or 54 is not applicable. We have to go to the rules. Now I'll come to the rules. First of all, Rule 27 says, where the consideration is not wholly in terms of money, then only this rule shall apply. I say I am a chartered accountant, I do the audit of my client, wherein he pays me, let us say, 1 lakh rupees as audit fees and a bike worth rupees 50,000. So once I am getting in consideration a sum of 1 lakh plus a bike, and the market value of the bike is 50,000, so the total value for this supply, that is my services being provided to my client, will be 1,50,000, and on which GST shall be levied. So in terms of this rule, if the whole consideration is not in money, then open market value if it is available. In my case, that similar kind of bike is being sold in the market. So obviously that price is easily available, which can be worked out. And if I can see that I am getting something which is not normally available, then, for example, I do an audit of an architect firm and I want to construct my own house. That architect makes certain drawings or makes certain drawings with regard to furniture also and provide it to me. Now, what is the price which is normally available in the market? That price plus the price which he pays me in cash is the value which need to be determined. So the similar kind of and quality, so similar kind of price which the architect would have charged if that house would have been belonging to some other person, not to the supplier, then that value is to be considered. If this value cannot be considered in terms of ABC, then of course the rule is you have to go to Rule 30 and 31, which are cost plus rules, and reasonable means, which we'll discuss when the terms will come. Now we come to Rule 28. Rule 28 is applicable only when supplier and recipient both are distinct persons or related persons. Related persons, as I told you, have already been defined. So we have to look at it whether we are related persons, and then distinct persons means any person with the same PAN number. Here again, the principle is very similar, that open market value of the supply, if it is not available, then value of goods or services are both of the like, kind and quantity, and we have already gone through this meaning. But what is really important is two provision. If I am supplying some material to a related person who is further intent to supply it to someone else, then at the option of mine, supplier, I can take 90% of the price at which my related person is supposed to make that payment as the transactional value on which GST can be discharged. The second proviso to this rule is very, very important. It provides that if you are distinct person and the recipient, that means the distinct person to whom the supply is being made, is entitled for the full tax credit, in that case, whatever value I declare in the invoice, that is the price on which that should be accepted as the price for the purpose of valuation of value of supply on which GST liability will be calculated. Once again, I am repeating, it's an important thing, and it applies in most of the trade where there are multi-locational offices. For example, I may have a showroom or a factory in Ludhiana, then I had showroom in Delhi also, Gurgaon also, Noida also, and I keep on transferring my material. And of course, those showroom of Gurgaon, Delhi and Noida, they are entitled for the full credit. So this is really important to understand. If that being so, what kind of planning? So there cannot be any litigation. If the recipient is entitled for the full credit, then in terms of the second proviso, the invoice price is the deemed price. So why one should like to undervalue when the credit is likely to be available? Let us understand this somewhere in detail. Let us say in my 3 showrooms in Delhi, Gurgaon and Noida, I am carrying a stock of 1 crore rupees. I keep on buying the goods and I keep on selling the goods, but the average inventory which I carry in these 3 showrooms is 3 crores. Let us say the cost of that product is 3 crore and the rate of tax on those items, for the sake of simplicity, I am taking one rate, is 18%. If I value those 3 crore rupees as 250 or 350, of course, in the long run, it will not have any impact. Whatever tax will be paid by the Ludhiana unit to the government is eligible as a credit to Delhi, Gurgaon and Noida offices. But yes, cash flow problem will be there. If I price it 2 crore 50 lakh, certainly I am saving 18% on 50 lakh because the average inventory carried out by these 3 showrooms is around 3 crore rupees. So barring this cash flow, there shall not be any other problem. But by undervaluing it or overvaluing it, besides the cash problem, in case I am into segment reporting, then it can have an impact because I want to know what is the real profit earned. That can be calculated only when I supply the goods at the open market value. So barring these 2 things, one has to take a guidance in case he is not interested in knowing the actual profitability, or he can make the adjustment subsequently. Then this second proviso really provided a great relief to everyone. Not everyone, in the case of distinct persons. So obviously we can make use of that provision, because in that case the government cannot challenge my valuation, as the invoice value is being considered as the value on which GST is leviable. Again, I am repeating for the sake of repetition, this provision shall apply only when full credit is available to the recipient. Now coming to the next rule, when the supplies are made through agent, as we all know, when the supplies are being made through agent, these are being considered 2 supplies, one by principal to agent and then ultimately agent to the ultimate customer. In such situation also, the value can be 90% of the price at which the agent is likely to sell the goods, or the open market value. An example has been given in the rule itself. In case you go through that example, that is very clear. So I don't think there is further any requirement to discuss this. But in case the open market value or the price at which the goods are likely to be sold, for example, in the case of paintings, it is very subjective term. I can send my paintings to an agent who is likely to sell it. And you know, the kind of art, if you're an art lover, you can pay 10 crore rupees for the same painting, and in case I negotiate, that painting can be given even at the 5 crore rupees. That is another thing. And let us understand, if you look at the GST law, then in the case of trader or manufacturer, there may not be much dispute with regard to valuation. Because in the case of trading, the purchase price is already available to me. And in the case of manufacturer also, most of the time my direct expenses, my raw material consumption, electricity consumption is being calculated. So obviously I am charging much more than my cost. So there is a benchmark which is available for the department, a benchmark for the SSC also to defend it. The problem comes where it is personalized product like painting I am talking to you, or maybe services. For example, an advocate who is sitting in an office and consuming electricity of 5,000 rupees may have income of 10 crores, whereas a person who is having a fleet of advocates under him and they are providing legal services to the lower section of the society, maybe he is earning 2 crore and his expenses may be much more than the individual senior lawyer who is charging very hefty amount. So the challenge will be more in the case of services and in the case of product which are specialized one. Then comes to Rule 30, value of supply based on cost. As I told you, it appears to be a very simple rule that in case we cannot calculate the value in terms of Rule 27 to 29 or Section 15, then we can use this law and we can build it on 110%. Yes, but how the cost of production is to be determined, that is a very important issue which can lead to litigation. We have seen in the excise law also, when the transactional value was manufacturing cost, there have been a lot more dispute between the department and the revenue. Now, another interesting observation is coming to my mind. For example, I am talking about now builder services. In the case of builder, land price, total amount is the land price plus the construction cost which I am recovering from my client, even if I am showing it separately, then I have to pay 12% of the total amount, even if I am showing the cost of land separately. In most of the cases where I get the land through succession, or my forefathers have purchased it 100 years down the line or 50 years down the line where the cost of land is not easily available, can I go to this formula and say 110%? Legally, there may or may not be a problem, but according to me, when there is a specific provision mentioning about construction in the rate notification, certainly it will lead to litigation, and I will never suggest you to go by this rule, and you must discharge the liability in terms of notification, that is 12% of the total amount received from the client. Then the residual method, if it is not being covered there, then of course there may be a number of supplies. For example, I am a person who is into shipbuilding and a ship is being ordered to me, and that shipbuilding may take a couple of years, and there are customization of ship depending on the facilities and the area being demanded. So certainly there cannot be any parallel, and even the cost cannot be determined for years two altogether. And in the case of continuous supply of service, I have to raise my invoices in terms of time of supply, that is section 12 and 13. So obviously this is a residual method which will come into picture when these 27 to 30 rules are also not applicable. In such exceptional situation, whatever is the reasonable price as determined by the revenue, and of course in case you don't agree with that estimation, you can always go to the court and challenge that valuation. Ultimately court will decide. Now we are coming to the special rate of tax, which are applicable in the case of gambling, money changing, LIC, etc. But what is really important to understand before I go through these rules is whether these are concessional rate of tax. Is there any restriction with regard to the availment of credit? No. Service tax also, there have been special rate of tax in Rule 6A, BC, 7A, BC also. Similar kind of services, whatever has been provided in the GST, same kind of special rates were there in service tax. Of course, the amount was different, or the quantum of the tax liability was different, but the principle and the nature of services are the same. There also I used to say, and of course now being accepted by the courts also, that these are special rate looking to the nature of the services provided by the client. So looking to special nature of that profession or that nature of service, a special mechanism is being worked out. But these are one way of discharge of liability. You are entitled for the full credit, even if I am discharging the liability. Then there are, restrictions. For example, in the case of tour operator, there is no restriction, but in the case of money changer, once I follow a method, I have to follow it for the whole financial year. Similarly, in the case of lottery, etc., it is a mandatory because it is a rule which starts with non-obstant clause, notwithstanding anything contained in this chapter. So obviously, but in rest of the cases, it is optional. I can always go to the normal section 15, read with those rules, or I can come to the special rate. Both the options are being made available to me. Unlike in the lottery, and lottery, it is lottery run by the state government. That means when the lottery can be sold in that particular state itself, and lottery authorized by the state government where it can be sold within the state and outside also. So the formula is already given. When it comes to horse race, etc., then it talk about 100% of the betting amount or the gambling amount, or whatever amount is being paid to the totalizator. Totalizator is a device showing the amount of bets staked on a race to facilitate the division of total amount, those backing the winner. So of course that is the mechanism and it's applied in the horse racing. So whatever is the value, on that full value, the tax is liable to be paid. When it comes to services on the sale and purchase of foreign currency, including money changing, it is absolutely identical as the service tax law. No change at all. But just for the sake of repetition, I'll repeat. It is the RBI rate difference, purchase price and sale price multiplied with the number of units sold. If the RBI rate is not available, then 1% of the Indian rupee. And if the consideration has been exchanged, let us say not in Indian rupee, let us say I am converting dollar into pound, then I have to replace those values into rupees, and whatever is the lower value, 1% of that shall be the value for the purpose of discharge of liability. And the same position was available in the service tax law also. And alternatively, another mechanism has been given that where I am charging 1 lakh rupees as my commission, then I can, 1 lakh rupees as my consideration, not commission, 1 lakh rupees consideration, then it can be 1% of the gross amount of currency exchange, subject to minimum of 250. Then if it is more than 1 lakh, then 250 plus 0.5%. If it is more than 10 lakh, then 5,500 plus 0.1%. As the consideration goes up, the percentage reduces, but you can choose any of these two options. Then comes services relation to booking of ticket for travel. What is really important is, even in the existing law, the same kind of special rates are there. In the case of domestic booking, it is 5% of the basic fare. In a ticket charge, there is a aviation fuel, there is another taxes also. What we have to calculate for the purpose of discharge of GST liability, it is the domestic booking, that is 5% of the basic fare, and in the case of international booking, it is 10% of the basic fare, and basic fare is generally that amount on the basis of which the commission is being discharged to the agents. And then comes services in relation to life insurance. If it is an annuity, that is 10% of the premium. If it is a recurring, not one-time payment, not one-time annuity, then it is 25% for the first year and 12.5% for the subsequent year. But this provision shall not apply, not mentioned in this slide, but kindly take a note of it. These provisions shall not apply where the whole premium belongs to risk. That means general insurance, there we are liable to pay tax on the full value at 18%. Then supply provided by a person dealing in buying and selling of second-hand goods. This is again a very interesting proposition. They say in the case of second-hand goods, if you are not claiming the ITC, that is the difference between the sale price and the purchase price. Let us say I am a dealer of a car, I am buying the car for 50,000, selling it for 60,000. I have to pay tax only on 10,000 rupees, provided no ITC have been claimed by me on the purchase of car. But any seller would like to disclose his margin. That is another problem in this formula. Of course, if the price is negative, somewhere I am wrong in my calculation. I estimate the cost of the car, let us say 60,000 rupees, but then I realize I am not finding a buyer, I sell it 55,000. Then that loss is to be ignored. It cannot be adjusted against any other consideration. Another car where I made a margin of 15,000 rupees, I am liable to pay tax of 50,000, and in case of loss, it has to be ignored. But the only thing is, in the case of profit also, would it be advisable for me to show the price and my margin to my customer? That is one very important issue. And once I am selling the goods which are being repossessed by me, for example, I am an NBFC, I have given some loan to Mr. A. Mr. A has defaulted in making the payment. Then I repossess that car and sell it. Again, it is a second-hand car. I have not claimed the credit, on which value I am liable to pay the tax. So the original price which has been paid by the original buyer when Mr. A has purchased that car, then that value has to be reduced by 5% per quarter. So the value of the asset is being termed as a 60 month, like in the case of capital goods. So that is the amount on which I am liable to pay. And the deduction will be available from the date of purchase till the date I sell the car. This is one important thing. In the case of token, voucher or a coupon other than a stamp, so whatever services I am giving in lieu of exchange of that voucher or coupon, those supplies at which rate they are taxable if they are being given for cash also, the same valuation shall be taken. The only thing is, rather than getting a cash, in this case I am taking a token, voucher or a coupon. Then comes the concept of pure agent. This is a matter which has been subject to litigation in the past also. It will be subject to litigation in the future also. Because I always try to split up my consideration and say part of it is reimbursement. First of all, let us understand, though the concept was there in the erstwhile law also, but it has lost much of its sheen. Now the litigation will be very, very less. Earlier on, union could not levy the tax on goods. Entry 54 in Schedule 2, only state can levy a tax. Union can levy tax only on services, 92C. But now both union and state can levy tax on both the goods and services. Secondly, the dispute whether it is a transaction of sale or transaction of supply, because of technical involvement, there have been distinction between goods and services or fading away. But forget about that. I'll take a very simple example. When I was giving my goods on leasing, where effective control and possession is imparted to the lessee, it was a transaction subject to VAT. And where effective control and possession is not being given, it was a transaction subject to service tax after 16 May 2008. Now, even under GST law, first of all, goods and services, both the government has got the power. So the question of splitting up and the taxability is also gone. Either it was a goods or a service, now you are liable to pay the tax and the tax is on the transactional value. So those issues will certainly, it will not much more litigated, but certainly litigation will certainly be there. Because the concept of pure agent, which was there earlier on, to qualify as a pure agent, there are 4 conditions. The same 4 conditions have been specified here also. But then you have to satisfy another 8 conditions, which has been reduced to 3. But the facts remains the same. If I am entering into a contractual obligation wherein some amount has to be incurred by the recipient by a pay on his behalf to the third party, in addition to my own supply, and claim on actual basis, then I am entitled to claim that amount shall not form part of the vessel supply. I'll take an example from our profession only. I'll just take 2 examples to clarify this position. Let us say I am a chartered accountant. I am an internal auditor to a company. I came to know that tomorrow is the date for TDS payment. In case that payment is not being made, the expense will not be allowed to the client. I call my client that this is the position, I am doing your concurrent audit and I realize that tomorrow is the date of internal payment of tax which has to be made. He says, sorry, I have forgotten to make that payment. Can you do me a favor? You kindly make this payment to the government on my behalf. Of course, I'll be using their TAN number, making payment to the State Bank of India, a third party, and then claiming this amount, either in the same invoice or raising a debit note. Certainly, this is an amount which I have incurred as a pure agent. In addition to my service of internal audit, I was not supposed to make the payment of TDS deducted on his behalf. So certainly that payment is simply to facilitate my client, and I have taken his permission. Payment has been made to third party. This is in addition to my service. So all conditions being satisfied, it's a pure agent. But let us assume, I am taking a very hypothetical example to make the issue clear. Let us say I had only one client. I had only one client and my whole office worked for him. So just for the sake of simplicity, if I raise my invoice, my office rent 1 lakh rupees, salary to the staff 2 lakh, my administrative overhead 3 lakh, and my professional charges 5 lakh, and the aggregate, let us say, works out to be 12 lakh rupees or 13 lakh. Am I liable to pay tax on the professional charges of 5 lakh or the aggregate amount? Certainly on the aggregate amount. Because all these expenses are incurred by me in discharging my responsibilities towards my client under the agreement. So whatever professional services I am providing, so I am incurring these expenditures to provide those services. So even if I split up the consideration, it cannot be claimed as a pure agent. And in fact, the guidance is available for so many landmark judgments now. Intercontinental in the Supreme Court has affirmed, Harveen and Company, Agarwal Color Lab, etc. And those principles have been very clearly dealt in and explained very beautifully what is the difference between reimbursement, in which capacity you are acting as a pure agent. So I'll suggest my professional colleagues to go through those judgments and understand this principle. Broadly, I have tried to explain what is the difference between amount incurred as a pure agent, which was liable to be paid by the recipient, but he could not pay because of any reason, and you discharge that liability. Payment has been made to a third party. He is responsible for the consequences, and we are recovering it on actual reimbursement, actual cost. Then certainly you can claim deduction as a pure agent. Now comes the applicable rate of exchange. It will apply in the case of import and export once I am making a supply. Then in the case of goods, this is applicable from 27th of July 2017. The law came into picture from 1st July 2017 for 26 days. There is a different rule that is not being shown in this slide. So this slide, the rule which is being shown is applicable from 27th of July, but because now we are dealing with the current situation, I can deal with this. In the case of goods, the principle is you have to apply the rate notified under section 14 by the custom department, which is being issued fortnightly. So you have to take that rate, and that rate shall be applicable on the fortnight for which the rates are applicable. It has no reference with regard to the RBI rate. I am talking about the rate notified by the custom department, not the RBI rate of dollar. Let us say today the dollar is 72 rupees 56 paisa, and the custom department has notified 72.50 for first fortnight of November. Then for the full fortnight, whatever may be the RBI rate, I have to charge only 72.50 as notified by the government. When it comes to services, then it says what is your general accepted accounting principle. Whenever you are raising the invoice, on that day you must be charging certain amount on the basis of exchange rate. You can take that rate, and that has to be consistently followed. Then comes duty value of supply. It was principle which was applicable in the earlier indirect taxes also. And so far as my knowledge goes, in the case of central sales tax, there was a section 8 which specifically talk about how to calculate the value of CST when the price is being inclusive of tax. So the similar kind of provision has been made in this rule. If the price is inclusive of tax, then it has to be calculated the value multiplied by rate of tax divided by 100 plus rate of tax. But what is really important and litigated in the previous regime was, if I have raised an invoice of rupees 100, contending that this service is not subject to tax, and tomorrow the department says, no, you are liable to pay the tax, your interpretation is incorrect. Am I liable to pay 18 rupees or 100 multiplied by 18 divided by 118? That means this formula. Court have now clearly held, if the price is inclusive of tax, that means your understanding was there, this price includes the amount of tax, then only it will be done. But in case you are contesting that supply is not subject to tax, in that case, it is 18% on the total value which I have calculated. So this is one thing which need to be understood. The judgments which are in favor are Opus Media, and the judgment which are against, I don't remember the name, but there are a number of judgments available now. Now I am coming to the frequently asked question released by the department, which are
already covered in my slot.
Valuation. I have been given to understand that these questions have already been covered by my other co-speaker, Abhay Desai ji. So I am not taking these questions. Of course, these are very important questions if it's dealt in detail. So if you understood these questions, I think all the principle will be very clear to you. So I am not dealing with these questions. Of course, I was having a couple of slides on that. Now I am coming to some advanced rulings which has been introduced on the subject of valuation, which further says what is the understanding of the department. With regard to the authority of advanced ruling, first of all, let me make it very clear to all of you that this ruling is applicable only on the applicant and the jurisdictional officer. It has no binding effect on me, but yes, it certainly has a persuasive value, and it can really help us in contesting the appeal. If the authorities, any authority, we all understand authority of advance ruling, it is the officer's rank below the rank of joint commissioner, and in the case of appellate authority is our chief commissioner. So if they have taken a view and I have taken the similar view, tomorrow it may help to be against me, then certainly neither the extended period can be invoked nor penalty can be levied. So there are two great advantages which I will be getting in case the authority is in my favor and ultimately the court ruled against me. So the first authority which I want to deal with is in the case of given by the West Bengal, and as you can see in the case of Premier Vigilance and Security Private Limited. In this case, they were providing service to the NBFC and bank for cash carrying, and while carrying the cash, they used to pay toll charges, etc. So my consideration was inclusive of everything. So I was charging a lump sum amount, let us say 5 rupees per lakh which I am carrying, and the consideration works out to 5 lakh. Out of that, I have paid 10,000 rupees as toll charges. Will that toll charges, being in the nature of tax, will be reduced? That was the question being raised. The authority said no, because you are charging the full amount. And as I have already explained, even if I add the value of toll charges, if other person is likely to get the credit, it is not going to have any tax implication. But yes, if the other person is not likely to get the credit, because in the case of NBFC, they had an option to claim only 50%. So it will certainly have a revenue implication. So in case they split up the transaction that I will charge you 4 lakh rupees plus the toll charges which are separate, or 4 lakh 90,000 plus toll charges separately, which will be payable by you, because that amount has to be paid by the recipient, not by me, shall not form part, and certainly some kind of tax planning is possible in this. Now, coming to the second authority which I want to deal with, that is by the authority of advance ruling Maharashtra in the case of North American Coal Corporation India Private Limited. Liquidated damages. Of course, in the negative list, if you go to the declared services, 66 capital E subclause E, it says agreeing to the obligation to refrain from an act, to tolerate an act, or to do an act is a declared service. So the similar kind of provisions are being given in Schedule 2 now, item 5E, and the language is absolutely same, agreeing to the obligation to refrain from an act, or to tolerate an act or a situation, or to do an act. There are various professional interpretations. This issue is now being debated in various courts at various levels, but no significant judgment has been pronounced on that. This authority says that all these liquidated damages are subject to tax. I had my own personal view. In case that liquidated damages is a deduction on account of deficiency of service, in my humble understanding, that shall not be subject to tax. But yes, if it is an integral part of a non-compete fees, etc., where I undertake a consideration and I agree that I will not open any outlet in this particular area under non-compete agreement, that is certainly subject to tax. So according to this authority, even liquidated damages are subject to tax. So reader or professional brothers must take a conscious view looking to the nature of liquidated damages which is being paid. If it is a deduction, let us say a contractor has raised me an invoice of 90 crore rupees of construction, and I find that this construction is not according to the parameters which have been agreed between me and the contractor, then certainly I deduct, let us say, 2 crore rupees. So in my humble opinion, that 2 crore is a deduction for which he has to issue me the credit note, and this 2 crore cannot be subject to GST. Of course, there can be a different view on that, so you are suggested to take your own view. Then the third authority which I want to deal with you is Maharashtra, again in the case of Ultratech Cement Private Limited. This is in relation to the post-supply discount. I think when I was dealing with the post-supply discount, I have already talked about that concept. But then here I would like to deal with that. In this case, it was general clause, and the authority said no, that discount cannot be allowed as a deduction, will be subject to GST. So kindly read this authority to understand the concept of post-supply discount. But before I move further, I would like to deliberate upon one trade practice wherein, two things are being given free when you buy 10. It can be the similar thing, or I can give you a different product. I am buying detergent, I am giving you shampoo free. So the question is, in that case, whether the free product can form part of the value and can be subject to GST, or in terms of section 75, 75 which says, clause E, goods lost, stolen, destroyed, written off, or disposed of by way of gift or samples, the credit has to be disallowed. According to my understanding, once I am buying 8 pen and then I am getting the 2 pen additional, it cannot be a gift. In my humble standing, it is a contractual obligation, not a ex gratia payment. So once I'll buy the 8 pen, then only I will be eligible for the 2. Then I will be liable to pay GST on the 8 pen which I have charged. Let us say the price of the pen is 100 rupees. So I will charge 800 rupees. I'll pay 800 to the applicable rate of tax, and I will claim the full credit of those 10 pen which I have sold. There is no reversal of ITC also required because it does not fall in the definition of gift. But in order to reduce the conflict with the department, I would like to suggest you can raise an invoice of 10 pen at the rate of 100 rupees, let us say 1000. Then you say discount of 20% because 2 pen have been given free, 200 rupees, 800, and you charge GST on the applicable rate. Certainly, this formula will avoid and obviate all kind of litigation, and the effect will be the same. The customer is getting the same thing. But this problem may arise in those cases where I am giving a gift and I don't want my customer to understand what is the value of that gift. For example, I am announcing that in case you buy 3 shirts from my shop, I'll give you one Swiss wristwatch. That Swiss wristwatch may range from 500 to 5 lakh rupees. So I want to create a confusion in the mind of the buyer, and I say I'm giving you a Swiss watch which is very expensive item. I don't want to specify. Of course, I can also do that. I can bill the 3 shirts, let us say 1000 rupees, 3000, then the cost of wristwatch 500, allow a discount of 500 and get rid of the problem. But in that case, my customer will come to know what is the value of the watch which is being charged. Even if I am buying the watch for 100 and sell it for 500, the department cannot have any objection to that. That is one area. In case you want your client to understand that this watch is worth 500, you can mention that and show the discount, which will be litigation free. But in most of the cases, when I talk to the businessmen, they say, no, we don't want to write that price. My customer may think of 5,000 rupees. Why should I mention 500? If that being so, in my humble opinion, again, it is a contractual obligation where he is entitled for the gift only when he is buying the 3 shirts, he is fulfilling his obligation. It cannot be a gift. You are liable to pay tax only for the price that you charge for the 3 shirts, and you will be entitled for the credit of the tax which you have paid on the purchase of that Swiss watch, which you are giving as a free item to your customer. Then the last authority which I would like to deal is really important, that is authority of advance ruling against West Bengal. This confirms the proposition which I was discussing with you. When the goods are being transferred from one person to another person under the same PAN number, the value declared in the invoice is the final price. Government cannot challenge it. And as I told you, in case you are really interested in knowing the actual profitability of different distinct person, you can bill it at open market value. There will be no financial implication because the unit, another person, recipient, is entitled for the full credit against that supply. Yes, as I told you and explained earlier, whatever is the average inventory which I am carrying with me, it will certainly result into more investment to that extent. So the call is with you. The law is with you. You can have even a price which is less than the cost, and then you can reduce your investment on the inventory which you are carrying. So this authority further confirms that invoice price or the invoice value shall be deemed to be the value of supply when the transaction is between two distinct persons in terms of section 25(4), and the receiver is entitled for the full credit. With these words, I would like to conclude my deliberation on this chapter of valuation. I hope you will find it useful. Thank you. Thanks a lot.